Index funds and ETFs for beginners. If you've ever wanted to invest but felt overwhelmed by complexity, you're not alone. Many beginners struggle to figure out where to start, which stocks to pick, when to buy, and how to manage risk. That's where index funds and ETFs come in. These simple, low-cost investment tools let you build wealth without needing to be a market expert. What are index funds and ETFs? An index fund is a type of investment fund that aims to mirror the performance of a specific market index, such as the S&P 500, NASDAQ 100, or MSCI World Index. Instead of trying to beat the market by picking individual stocks, index funds simply match it. This gives you broad exposure to many companies at once, reducing your risk if one company performs poorly. An ETF, short for Exchange Traded Fund, works almost the same way, but with one key difference. It trades on the stock exchange, just like a regular stock. That means you can buy and sell ETFs throughout the day as prices move, unlike traditional mutual funds, which only update once daily. Why investors love them? Index funds and ETFs are popular for two main reasons: simplicity and cost efficiency. With one investment, you instantly gain exposure to hundreds or even thousands of companies across different industries. This diversification helps smooth out the ups and downs of the market, which is perfect for long-term investors who don't want to time every price movement. Understanding expense ratios. Every fund charges an annual fee called an expense ratio. This covers the fund's operating costs, including management and administration. The best part? Because index funds and ETFs are passively managed, meaning they simply follow the market rather than try to beat it, their expense ratios are usually very low. For example, a typical index ETF might have an expense ratio of just 0.05%. That's 50 cents per year for every $1,000 you invest, while an actively managed mutual fund could charge 1% or more. Over many years, those small percentage differences can significantly impact your overall returns. Building a balanced portfolio with ETFs and index funds. One of the biggest benefits of index investing is how easy it is to build a strong, diversified portfolio. You don't need dozens of assets. Just a few broad-based funds can cover the entire global market. Here's a simple example of a beginner-friendly portfolio. U.S. Stock Market ETF covers large, medium, and small American companies. International Stock ETF adds exposure to global markets like Europe, Asia, and emerging economies. Bond ETF provides stability and reduces volatility during market downturns. If you want to keep things even simpler, a total market or all-in-one ETF that includes both stocks and bonds can do all the diversification for you automatically. DCA, Dollar Cost Averaging Explained. One of the smartest strategies for beginners is dollar cost averaging. This means investing the same amount of money at regular intervals, for example, $100 every month, regardless of whether the market is up or down. The beauty of DCA is that it removes emotional decision-making. Instead of trying to wait for the perfect time, you invest consistently, buying more shares when prices are low and fewer when prices are high. Over time, this evens out your average cost and keeps you focused on the long-term goal, growth through compounding. Compounding, the hidden power behind long-term investing. Albert Einstein allegedly called compound interest the eighth wonder of the world, and for good reason. Compounding happens when your investments earn returns, and those returns start earning returns too. For example, If you invest $200 a month into an index fund with an average return of 7% per year, after 20 years you would have contributed $48,000, but your total balance could grow to over $100,000. The earlier you start, the more time compounding has to work its magic. ETFs versus mutual funds. Which should you choose? Both ETFs and mutual funds can track indexes, but they differ in how you buy, sell, and manage them. Trading flexibility. ETFs trade all day on the stock exchange. Mutual funds are priced once daily after the market closes. Fees and minimums. ETFs usually have lower expense ratios and no minimum investment. Mutual funds often require a few hundred or $1,000 to start. Tax efficiency. ETFs are usually more tax efficient because of how shares are created and redeemed. Automation. Mutual funds are easier for automatic monthly contributions, while some brokerages now allow recurring ETF purchases too. If you prefer simplicity and flexibility, ETFs are often the better choice. If you want to set it and forget it through automatic investments, mutual funds might suit you. Common mistakes to avoid. While index funds and ETFs are beginner-friendly, there are a few traps to watch out for. Over-diversification. Buying too many overlapping ETFs can end up duplicating holdings. Short-term trading. ETFs can tempt investors to trade frequently. Stick to your long-term plan. Ignoring costs. Even small expense ratio differences can add up over decades. Always check fees. Emotional reactions. The market will rise and fall. Stay consistent and avoid panic selling during downturns. The long-term mindset. Successful investing isn't about timing the market, it's about spending time in the market. By consistently investing in low-cost index funds or ETFs, staying diversified, and letting compounding do its work, you can steadily grow your wealth over years and decades. Think of it like planting a tree. The best time to start was yesterday, but the second best time is today. Final thoughts. For beginners, index funds and ETFs are the easiest and most reliable ways to start building an investment portfolio. They're low-cost, diversified, and time-tested. Focus on investing regularly, reinvesting your dividends, and staying patient, because true financial freedom comes from letting your money work for you while you focus on living your life.